right, here we go. Hello, everybody. Welcome to the TraderMerlin Show. It is your Thursday edition, a special Thursday. We were actually going to have Bill on the program on Tuesday, but I got called into some meetings, as happens occasionally, and we had to push that one off. But it's a very timely topic. For those that watch Power Trading Radio many years ago, we actually did a special where we talked about the repo rates. What we'll do today is talk a little bit about the repo rates, but also dive into the reverse repo market. What are some of the implications for our current markets, and what all this means to you and me. Joining me, I'm assuming from the East Coast, we've got Mr. Bill Addiss joining us. Bill, how you doing?
Great to see you, Merlin. Yes, joining you from a beautiful Washington, D.C., or suburb thereof.
Boo, hiss. Right, we'll just right, the Washington, D.C. part of it.
I'm in the swamp.
Good. Well, I'm glad we caught you in between gigs. For those that don't know, Bill does a lot of classes for Online Trading Academy. We'll talk about that coming up. He also teaches for bond markets. And I think, tell us about your class that's starting tomorrow. I'm curious about this. Who are you teaching for?
Yeah, a little firm called the New York Fed. I'll be doing a day of training classes. I actually do 2 days every summer for the New York Fed. My client base away from OTA is all institutional. You know, this summer I'm with the Goldman and the Citibanks and the HSBCs and the Fed. So I'll be working with their new hires to help them understand what the Fed does.
Yeah, you said something funny earlier. So it said, you know, it's weird that the Fed wouldn't have anybody inside the Fed that could train their own people about how the Fed works. But hey, you know what? We'll just congratulations. I wish I could sit in that class.
It's a fun gig, actually. They're a good group, I have to say. They're very enthusiastic. They're a fun group of new hires.
I would be too, especially somebody that has your experience and storytelling abilities. Talk to me a little bit about the repo market. So for those who don't know, Bill, actually you did work on a repo desk, right?
I actually ran Shearson. If any of you might remember Shearson years ago, they got bought by Lehman. I actually ran Shearson's repo desk for a while, and then even when I didn't run it day to day, it reported to me. So I know this is a topic that's been on my radar screen for about 40 years. But what amazes me is usually people outside the industry have no idea what it's all about.
Right. It's
very specialized. But repo is the financial engine that literally runs Wall Street. It runs our economic machine.
It's funny how we hear about things and you don't really know the full scale, scope, and impact of what they do. When you were on the program back in, I want to say it was mid to 2019, we had a different discussion. Today we'll talk about kind of the repo market, the reverse repo market. Back then we saw a spike in the repo market yields, which you were like, wow, this is kind of unprecedented, seeing it spike this much. And the main argument you made was it's because we have a lack of capital in the markets. And let me show the viewers out there a picture of what we're talking about. This is on the top, you have the cash going into the system, into the repo markets. At the bottom is the interest rates being charged. And what we're talking about is this spike right here, where we went to over 5%. And that was a pretty significant spike in a very short period of time, which it was concerning that could have brought down the whole financial system, and it was due to lack of cash in the system. Right. Now all of a sudden we find ourselves in this situation where, notice since early 2020, when we went back down to zero on the Fed funds rate, we're stuck at zero on this on the repo rates, and also what's noteworthy is this massive spike in capital going into that market right now. So let's start off a high level and say, what is the repo market? You mentioned it's so critical, it fuels Wall Street. What does it do?
Great question. So I have to get a little eco-nerdy here, so forgive me. But yeah, sorry. But I need everyone listening to realize that cash is an asset just like anything else. And the value of that asset changes with supply and demand. Right. So if a lot of people need to borrow money, or money is scarce, the interest rates relative to borrowing cash go higher. Conversely, if there's a lot of money out there and we're swimming in cash like we presently are, no one's aggressively needing to borrow it, the rates can go low. And when I grew up, we always thought that zero was the lowest rate. And we presently know that's not the case, that it could even go below zero. So think of cash subject to supply and demand, which the OTA Academy is comfortable with. And the other thing, and I'll explain what repo is in just a moment, but indeed more detail, but a repo is basically a one-day collateralized loan. It's backed by treasuries, and we'll get into this more, but it's always for one day, almost always for one day. Right. And therefore, because it's a one-day, very safe interest rate, the repo rate and the Fed funds rate traditionally trade right on top of each other. As you know, we've talked about it. The Fed funds rate is the rate that banks charge each other to borrow money. That's the rate that the Fed sets. So the Fed funds rate, a one-day very safe rate, and the repo rate, this collateralized loan that we're going to explain, usually trade right on top of each other. And with the proliferation of money that we now have in our economy, I mean, M1, the amount of cash in the economy, has just exploded. We're swimming in cash.
Right.
What could literally happen is those interest rates could have gone negative. So with that as a background, let me better explain what a repo is. And forgive me, for some reason, I'm not seeing the slides. So do you have that repo slide up?
I can bring it. Yeah, you won't see my slides, unfortunately.
Okay. All right. But if you would put up that repo slide we were talking about. So here's the situation. The Fed is saying, okay, our banking system is awash with cash. So what the Fed offered to do at the last FOMC meeting last week, they said, look, we will take in your cash. If you, the banks, if you, the money market funds, if you, particularly the money market funds, let me come back to that because they're sitting on a lot of cash. So what the Fed said to the money market funds is, look, if you want to lend your cash to us, we will lend you collateral as security against that, and we will pay you an interest rate of 0.05% for you to lend your money to us. Now, that rate had been at 0. And again, if there was too much cash, that rate actually could have gone negative. And that would have really been a real problem for everybody in the OTA community. Because I'll guarantee you, all of your listeners use money market funds as a way of sweeping their brokerage accounts to try and earn some minimal rate of interest. And on a money market fund, as you know, when you give that fund manager a dollar, you always expect to get a dollar back.
Right.
But that dollar's not fixed. It's not guaranteed.
Right.
That could fluctuate. So if interest rates went negative on repo and money market funds were investing in that product, you would have got broken the buck on a money market funds. And we don't want to see that.
It has happened before. We have had a broke buck before, yeah.
Yeah, and it was a real problem when it did. The firms decided not to pass it on to their clients. They ate that cost. So, it's important for the integrity of the system, the money markets, to keep that at a dollar.
Right.
So the Fed basically said, okay, we're here to suck up your money. We will offer you a 0.05 interest rate if you will lend it to us. And by doing that, what the Fed basically said is, we're now providing a floor, right? Even the rates are not going to go lower than 0.05 because we're the Fed and we're willing to suck up all that liquidity. So the way it works is mechanically, you've got the chart up there. So on day one, let's say today, the Fed says, we will lend you collateral. Treasuries. The Fed's got this huge portfolio of treasuries just sitting there. So they lend them out as collateral and they borrow money from the clients like the money market funds. Then on day two, literally the next day, this transaction reverses itself. The next day, the Fed will take in the collateral they had lent out and they'll give back the money market funds they had borrowed plus a rate of interest of 5%, 0.05. And the reason it's called a repo is I'm describing it as a collateralized loan. And that's really what it is. But if you actually look at the books and records of the Fed and the money market funds, it looks like the Fed is selling the bonds to the client, the funds, to take in that cash. And then the next day, repurchasing those bonds back again, hence the name.
Right.
But, so mechanically, it looks like a purchase and sale. Functionally, it's really just a one-day repo.
And you talked about 0.05% real quick. So 0.05, that's annualized.
You're correct.
Yeah, because I was going to say that's a hell of a rate of return. I want to do that.
Well, at least it's not negative. That's really the point.
Right.
The Fed was basically saying we're here to provide a floor. The money market funds are now safe. But when the Fed made that announcement last Wednesday that they were jacking that rate up from 0 to 0.05, that night they got $756 billion of money came in of clients looking to take advantage. And that was about 3 times what we've been averaging on a daily basis. Yeah. And that number has been maintained.
What else would they do? Like if they're offering 0, there's not really an incentive for the money market funds or the banks to lend those bonds.
Well, the point is what would the Fed be doing with them?
Well, what would so you're kind of incentivizing me. The Fed's saying, hey, we'll buy them from you and give them back tomorrow. Great.
Right.
So I'm incented to sell them to you. If I'm a bank, if it's at 0, there's really no interest and no reason for me to go to you, the Fed, and sell these. Now all of a sudden they raise the rate a little bit. It's like, okay, now I have a place to park that money. What else would these banks be doing with that money?
Well, see, that's the problem. Don't even think of the banks so much. Let's stay with the money market funds. Money market funds have cash balances every day. And that money has to go somewhere. They can't keep money idle, because think about it. If you're a money market fund and you've got tens of millions of dollars, you're not going to keep it at a bank, because that's not an insured deposit. You're putting yourself at risk. This is the problem we see in Europe. Even when interest rates go negative, money market funds still have to invest in these negative yielding products. And basically, the clients just have to suck it up. The money market fund literally is legally not going to sit on cash, because that would be an uninsured deposit. Here, we don't necessarily like the interest rate. I'll agree with that. But at least it is a safe, collateralized obligation. The money market fund is fulfilling their fiduciary responsibility by investing in that. They're not necessarily, when they invest in cash, which would have to be parked somewhere uninsured.
All right.
So they're kind of hostage to have to invest in, quite frankly.
I have no problem with being banks being hostages.
Yeah, really.
All right, so when we look at the reverse side of this, so obviously there's the repo market is normal. That's a staple, the backbone of financial systems, where that money is constantly being put to work, so to speak. In a reverse repo, is this a warning sign? Is there something that's systemically wrong?
No. I see your question. No, it's really just a terminology discussion, because let's go back to day one. When the Fed lent out their securities as collateral, they were doing a repo. You lend out collateral on a repo.
Right.
On that same day, the money market funds that are delivering the collateral, on day one, they're doing a reverse repo. So on day one, the Fed's doing a repo, the clients are doing a reverse repo. On day two, that reverses itself. The Fed is now doing the reverse repo, because they're taking the collateral in, and the money market funds are now doing a repo. So literally, for every repo transaction you do, on the other side of that trade, the counterparty is doing the reverse.
Got it.
Doing a reverse repo.
All right. Well, I just getting the terminology, because we've heard, you hear in the industry so much about repo, reverse repo, and various transaction pieces, and the focus has been on the reverse repo side of it now.
Because when the Fed does it, they kind of look at it. When they propose it, they're saying we're offering the clients the opportunities to do reverse repos with us.
Right. So we can keep going down that path. There's obviously tons we could talk about. Is there anything noteworthy from your perspective about the amount of capital coming in? And I had a chart here. Let me show you guys real quick. Here is a chart showing the overnight reverse repo, but you can see just the spike. Back in 2002, we were looking at almost $300 billion. Now in 2021, we're looking at almost $500 billion. And really, for the past 20 years or so, not 20 years. Take that back. Sorry, my numbers are wrong. It's 2020 was when we had that $300 billion, and then we recently saw the spike. So you're really looking at a year of solid, stuck at zero, almost nothing happening in the reverse repo, and now all of a sudden it's surging. Is this noteworthy? Should I be nervous about this? Should the financial institutions be nervous?
Good question. No, I think if anything, they should be more assuaged. They should be more calm, because this is actually this is really a function of two things. Number one, this is an acknowledgement that the Fed is worried about all the cash out there.
Yeah, they should be.
If you look at the traditional causes of inflation, it's too much money chasing too few goods. We all learned that in our traditional Keynesian economics. So I think what the Fed is doing here is they're sucking liquidity. Now, they're doing two things. Number one, they're providing a positive rate of return for the money market funds, and that's the one function we talked about. But the other thing the Fed is doing is they're sucking all of this money out of the economy, because I do believe they're worried about inflation. The Fed, and the press hasn't picked up on this, I don't think adequately at all. The Fed has started raising rates. The Fed has started tightening. They're doing it a little more discreetly.
Discreetly, right.
But this is a perfect illustration. Again, if the Fed is sucking cash out of the system, what should that ultimately do to these rates, is start raising these rates up again?
Yep.
So this is effectively a subtle tightening maneuver.
Sure.
The Fed is starting to clamp down, making money less available, wanting those rates to go up. And the Fed also, has done two other things during the month that are actually tightening maneuvers that the press isn't focusing on at all, which I think is very instrumental. The press is inadvertently kind of a co-conspirator. The Fed is, I'm convinced, my opinion is, the Fed is tightening but they don't want to do it overtly. The press is used to looking at the Fed funds rate as the only thing the Fed does.
Right.
And we all talk about what the Fed funds rate. The Fed controls a lot more rates than the Fed funds rate, and they're starting to raise those rates. And the press isn't picking up on it. They're looking at that Fed funds rate and saying, well, the Fed's going to keep it there, they say, until 2023. That's the message that's going out, when in fact the reality is the Fed started tightening.
Yeah, and you look at the dot plot, and that all of a sudden shifted. It might not be 2023. It looks like 2022. We talked about in this program that there's really kind of three key things the Fed can do to stave off inflation. Number one is rein in money supply, which right now doesn't seem like they want to. I mean, they're just printing more and more with stimulus and everything. So you got reduced money supply. You have raise interest rates, right, which would obviously choke the economy a little bit. And the third one was raise reserve requirements, which right now are stuck at about zero for the banks. You've got a huge influx of tens of trillions, but we'll just say many trillions of dollars going into the market, and rates have been going up, but not significantly. At least they've hesitated a little bit, but I think you're right. I think by raising subtly in different areas, it's a sign. And they also dropped the word transient from their talk track, which I thought was kind of funny, because I brought up so many price charts of different commodities and market items. You're going, it's clear. Inflation is everywhere, and it might be much higher than they're saying.
Right. And yes, no, it was very noticeable that when Powell did his press conference, he never used the word transient once.
Nope.
Versus the last press conference when he used it 13 times. Not that we count these things.
No.
Analyze this. But yeah, he went from 13 times talking about transitory to zero. If I could, I'd like to explain a little bit of what the Fed's done.
Sure.
It's so surreptitious, but really does show the Fed is in a tightening mode.
Let's do it.
And the timing by which they've done. So, for example, we had the FOMC meeting last 15th and 16th of this month. And when the Fed came out, they said, no change on interest rate policy. We're keeping Fed funds at zero. What I always thought was interesting was 1 week before the FOMC announcement, literally 1 week before the announcement, the Fed came out with an announcement saying we're going to be selling our corporate bond portfolio that was amassed under QE2, under quantitative easing. I mean, realize last year, the Fed authorized themselves to buy up to 10% of the corporate bond market, the entire market. The Fed was in there buying bonds in the secondary market. They were buying bonds new issue. And the Fed had almost $500 billion committed to the corporate bond market. In prior QEs, they'd never done corporates. They'd only done treasuries and mortgages. Well, they announced 1 week before the meeting, that they were going to start liquidating their corporate bond portfolio. That's pretty significant.
Sure.
I mean, the Fed had provided such stimulus to the corporate bond market that credit spreads in corporate bonds got very unattractive. The yields, the credit spread you get on corporates is absurdly narrow. That's thanks to the Fed being in there buying up so much of the corporate bond market.
Right.
Now the Fed has literally gone the other way. They're starting to dump those bonds. I think the reason they did that the week before is they didn't want to bring a lot of publicity to that. They would have announced that as part of the FOMC meeting. That would have been a major part of the discussion. By subtly announcing it a week before the FOMC meeting, I think they wanted to keep it off the radar screen.
Yeah, and it's interesting because it wasn't a talk track. That's something that you really didn't hear much about. And that was actually a really concerning piece early on, that you're seeing this transition of corporate debt getting, lower ratings, and they were buying up a bunch of it. Now all of a sudden they're unwinding. It's like confusing. And the one that also gets me is they're still doing it. I believe it's the tune of, I think what they said they're doing, was it $80 billion a month of treasuries and $40 billion of mortgage-backed securities, I think were the numbers they threw out.
Right. That's go ahead. I'm sorry.
Riddle me that. Why? In my mind, I look at if these actions by the Fed to purchase these should be to prevent maybe a downward slide or sell-off in those. So if they're buying mortgage-backed securities in 2008, I get it. A lot of that stuff was absolute garbage. You're saving the market. We're in one of the most robust, booming housing market cycles ever, and here they are buying mortgage-backed securities. So I'm just curious as to why you think they would be continuing to pursue. Is it to continually inflate those markets?
Yes.
Okay, well, didn't take you long to respond to that one.
Because I share your same frustration.
Yeah.
The Fed's out there, and just to explain to everyone, the $120 billion they're buying is an average. Some months more, some months less. And this is the Fed literally just sweeping their account and reinvesting their interest in principal every month. The Fed's got this huge $7 trillion portfolio, And this portfolio was paying interest like any other bond portfolio. They've also owned these bonds long enough that they're starting to mature. So what the Fed is doing is they're literally taking their monthly proceeds from that and reinvesting it back into the market. So technically, the Fed is on hold from quantitative easing. They're not printing up any new money. They haven't since September. But they're still in the market as a substantial buyer just from the reinvesting of the proceeds from this huge portfolio. But you're right. The fundamental concept of them doing this is to support a market that needs help. The mortgage market doesn't need any help. As you said, we've got record real estate prices. Mortgage yields themselves are aberrationally low. If you look at where mortgages should trade traditionally relative to the 10-year Treasury, those mortgage yields should be a lot higher. So, the Fed is out there actively supporting a market, quite frankly, that doesn't need supporting. My concern is that leads to bubbles.
Right. I was going to say, that's obvious an area of concern. And if you are putting a footing underneath the housing market and continuing to prop this thing up, it just further accentuates or grows that bubble, which we've talked about. We did a webinar recently called the Everything Bubble, which was great. And we talked about the bonds, the equities, the real estate, even the cryptocurrency potential bubble. So, these things get inflated. And when you have somebody like the Fed who pretty much has unlimited balance sheets, they can manipulate things in a big way. So I saw that at the meeting on Wednesday, and I was pretty like, wow, really? I get the treasuries, but the mortgage-backed securities kind of threw me for a loop.
Yeah, I'm with you. Makes no sense whatsoever. And just to kind of continue, the other interest rate they raised at the meeting, which again the press didn't focus on at all, is what's called, and I'm going to get nerdy again on you, IOER, interest on excess reserves. And this also personally drives me crazy because what the Fed has done is they now are willing to pay the banks just to leave their money on deposit at the Fed. So if you have more money at the Fed than you need, the Fed is now paying you 15 basis points for them to hold your money.
Yeah, I have to fix the slide you sent me because it actually looks like you're saying from 10 to 15%. It's basis points, guys.
Basis points, yes. 0.10 to 0.15. Yes, sorry.
Because if that's the case, I'm sending my money to the Fed today.
You wouldn't need both. I'll become a bank overnight and start sending them money that I can earn 15% on. Yeah, no, sorry. There's a decimal point I should have put there.
I'm putting it in right now because I'm sure somebody will call us out on it and be like, wait a minute, that was wrong. There you go. We fixed that one.
Thank you. Yes, 0.15. But here again, if the goal of the Fed is what is the impact of that? Is that the banks are just going to leave their money at the Fed. So here again, this was a tightening maneuver. Back when the Fed wanted to stimulate the economy, when the pandemic hit, they dropped the interest on excess reserves to zero. Right. And the idea was, let's get the banks to do something with their money, not just park it with us. Now, by offering 15 basis points, the Fed is saying, we'll compensate you to do absolutely nothing with your money. Again, this is a tightening maneuver. And yet, you look at the press, they're talking about, the Fed didn't raise interest rates. No, but the Fed is still tightening. They only didn't raise the Fed funds rate. They're raising these other interest rates.
Right. Yeah. It's very interesting to me, the maneuvers, because you look at, if they raise it to 15 basis points, if I'm a bank, I still am looking at, I'd rather lend this money out to customers at 3, 4, 5, 6, depending on what the rate of return is. So again, how am I being incentivized to go keep it with the Fed versus lend it out and make greater rates of return? Does it have to do with like my reserve requirements, which we can talk about the stress test a little bit later on?
Yeah, well, I do want to point out, though, when the banks are lending that money out to you at 3%, they're turning around and putting that mortgage into a bond where they're paying the bondholder 2.5% of that. The mortgage companies are only keeping 50 basis points for themselves, and they're having to service those mortgages and take on the risk of the mortgage holder. So don't look at it as 3% that they're giving up. When you issue a mortgage, they're only making about 50 basis points. So suddenly that 15 basis points risk-free with the Fed with full-day liquidity. You're not tying your money up for 30 years here. This is same-day liquidity. Suddenly that 15 basis points, I think, actually does look a little more attractive.
All right, okay. All right, so you got a list here. I'll run through them because we did the third one already. We talked about liquidating corporate bonds, which is interesting. They've been really buying those ones up. Raising the IOER, which is the interest on overnight excess reserves, or interest on excess reserves. And then the last one is the repo market. Now, these are all maneuvers to tighten, which, of course, I feel is much needed given the fact that inflation to me seems way higher than they're saying. From your perspective, what are the next steps here? I mean, this to me is just like a start. Is this the beginning of maybe much more tightening coming forward if inflation does, in fact, keep rising?
Good question. So my fundamental premise is the Fed is trying to tighten without telling us they're tightening.
Right.
They want their cake and eat it too. And there are other maneuvers that we can do that they've done in the past, if you remember back to the 2008 through 13. So the next one we might see is the Fed doing Operation Twist. Mm-hmm. Right? And that's where the Fed is going to change the maturities of their portfolio. So, let's say that they make a decision that you might have noticed in the last couple of weeks, the 5-year yields have risen rather dramatically. So let's say the Fed decides we think that's too high. What they could do is they could start selling their longer maturity bonds in their portfolio and start buying the 5-year. And driving that price up and yields down. That's what we're talking about here is yield curve manipulation.
Right, exactly.
But that's what quantitative easing is all about anyway. We don't call it that, but that's what it's all about anyway. So the Fed could start playing with the maturities of their portfolio, and we refer to this as Operation Twist. And it has impact to the yield curve. So, those of you who do the flatteners and steepener trades, this could be pretty significant. And then the ultimate thing that will really be the Fed throwing in the towel and admitting that they're done, it would be the two things. One is raising the Fed funds and the discount rate, and that's what they'll do last because that's what the press is going to focus on the most. And the other is that when they start announcing they're going to start tapering, where they actually are going to start unwinding their balance sheet. When the Fed announced that back in 2013, if you remember, we had what was called the taper tantrum.
Yep.
Bond yields shot up dramatically overnight when the Fed announced we're done. And now we're going to go the other way. We're going to start pulling money out of the market. I mean, the bond market reacted hugely. We refer to it as the taper tantrum.
Right. It's a great name.
So, there's some subtle things they can do, like Operation Twist, which I think will happen next. And then there's more dramatic things they can do, which will ultimately get a rise to the Fed funds rate and a rise to the discount rate and the tapering.
Well, next time we have you on, we'll play Chubby Checkers Twist in the background just as a...
I'm accused of doing my yield curve dance by OTA. When I start talking about short-term and interest rates, I do this. So I've been accused of doing the yield curve dance.
Nice. Well, it can't be any worse than the Elaine Benez dance from Seinfeld.
At the end of the movie, yes.
Yeah. So today we also had the stress test, and I was curious to see how this one would pan out, simply because you look at the reserve requirements being zero. The banks have, of course, the Fed wants them to be lending out money, get this economy back on track. When you have reserve requirements at zero, to me that just basically means infinite margin. Basically, yes. they can continue to lend out as much as they want, and that's scary to me. Reserve requirements basically say, keep some of my money on hand just in case the shit hits the fan. And it kind of makes me nervous because 23 of the banks passed their stress test today. And I'm like, man, you don't have any reserves.
Right.
I feel like this is setting up to be another potentially dangerous aspect here, to have zero reserve requirements and all these banks passed with flying colors. And for those that are long the market, you probably like this, they have lifted the restriction or are lifting the restrictions on share buybacks and dividends for financial stocks, which to me is another potential catalyst to the upside for the market, add more fuel to the fire. Any perspectives on the stress test today from your...
I have to say, if you can't make money in today's market as a bank, you shouldn't be a banker. I mean, let's be honest. You've got 0% interest rates, right? You're a bank, you're borrowing money at zero in the Fed funds market. Whoops, sorry.
I thought it was an earthquake. Now I'm the one living in California.
I just got too excited. Well, you're in California, so you're used to that being an earthquake. Sorry.
No worries.
So you're borrowing money at 0%. You have no reserve requirement, so you don't have to commit capital to the Fed. I mean, if you can't make money in that environment, you shouldn't be a banker.
Right.
But I agree, and I've got many friends on the credit side. The fact that the banks have zero reserve requirements scares the market. I mean, think about it.
Scares me.
Think about your clients at OTA. If you could trade futures contracts without any initial margin, that's basically what we're saying, right? You don't have to put up any collateral. I mean, wouldn't that put a heck of a lot more risk in the market in terms of counterparties? You might like it for your purposes, but realize the counterparty you're trading against also isn't putting up any collateral.
Well, I think it this way. I mean, and hopefully that's a great example. Imagine you guys are trading futures, and normally, you buy one Bitcoin futures contract, you can put up $60,000. Now you don't have to put up anything.
Right.
You can just buy it. It is so dangerous. And you said probably right, Bill. It's for me, it's fine. I could care less if they change that because I'm a very good risk manager. That's like first and foremost what I have to do as a trader. Right. But I know so many people coming through whatever school you're going through about trading and you're still learning things. A lot of people, that's why they blow their accounts, is they don't practice good risk management. Now, now I have to trust that these banks have been practicing good risk management. And to me, you're going to get a few of them which are certainly practicing good risk management. You're also going to get a few other ones that are going, well, holy shit, I can now do whatever I want with this money. I've got tons of it. I'm going to leverage myself to the hilt. Bear Stearns, Lehman Brothers, the over leveraging could destroy them in one black swan event. They're done. And that's scary because there's people with money at those banks. And to me, a reserve requirement is there for a reason. Fractional reserve banking is, and you want to talk about a Ponzi scheme, I mean, it's getting there.
Yeah, now Lehman wasn't a bank, so it's not a totally apt comparison for me to make. But, one of the reasons Lehman went under, and, I have to confess, I'm a former officer of Lehman, as many of you know. One of the reasons Lehman went under is they were leveraged up 33-1 when they went under.
Yeah.
That's absurd. Now, again, they were not a bank. That was part of the problem. But, in that function institutionally, we can use the word leverage and risk interchangeably.
Absolutely. Are you up on, this is a question that came through, Brendan loves, he's always got some macro stuff. Do you follow modern monetary theory at all?
I do.
You do? Oh, all right.
Just to cast aspersions at
it. Well, because he says, he's asking, Bill, is there any way around it?
No, and then, Brendan and I've had this conversation, so good to talk to you, Brendan. Effectively, the government is engaged in modern monetary theory because MMT basically says, and forgive me, some people with aspersions call it millennial monetary theory because it says you can spend without any repercussions or ramifications. I mean, one of the fundamental tenets of MMT says don't worry about the deficit. We're not going to pay it back anyway, so just spend. Once again, I think if you tell Washington you have uncurtailed spending, you've got problems. But effectively, that's what we have now.
Well, you've got a party. You've got a party, and then you have problems, right? If you don't have to control your spending at all. It's like I can do whatever I want. I'm going to town, but the ramifications later on are going to be tough.
But for all intents and purposes, Washington is spending as if there's no constraints.
Sure.
We were having a bigger deficit this year than we had last year. And as you know, last year was our record. I do have to point out, I wasn't going to mention, because honestly, it's not even on my radar screen, but remember the old debt ceiling problems that the government was hitting the limits of how much we could borrow? Well, they suspended the debt ceiling for 2 years. I have to remind people the debt ceiling comes back into place on July 28th.
Really? That was 2 years ago? Man.
Yeah, if Congress doesn't raise the debt ceiling by July 28th, guess what, folks? The U.S. government just went into default. We won't be able to pay our bills.
They'll raise it. Come on. You know they're not going to go into default.
Yeah, they'll do it on July 27th at 11:55 at night, not that they wait till the last minute. But no, of course, they're not going to let the U.S. government go into default. But that is what would happen. So, we have to raise the debt ceiling by July 28th, or this whole problem that we used to deal with every year is going to come back and haunt us again.
Well, I mean, it's those events which keep things interesting, right? I mean, it's always something. It's funny because a couple of years ago it was all about the trade war with China and tariffs, and I haven't heard anybody say a word about trade wars or tariffs. It'll all just come circling back around, and pretty soon I'll be wearing bell bottoms again. So it's all, everything comes back around.
And I have to say, and I'm being critical, but I think it's well warranted. I have to blame the financial press. Just like the regular media, they're only able to focus on one thing at a time.
Right.
And I just recently, as an illustration, because this really bothers me, I posted on my LinkedIn yesterday a copy of the Financial Times from the day after the Fed meeting saying Fed keeps interest rates unchanged. That's the headline. Or, no, interest rates won't rise until 2023. Pardon me. Mm-hmm. Interest rates won't rise until 2023. And at the very bottom of that article, which recapped the Fed meeting, they said, oh, yeah, and by the way, they did raise the interest rates on excess reserves and the Fed lending facility. It's like, guys, you buried the lead. The lead is the Fed was raising rates. And yet, the article's headline from the Wall Street Journal, probably FT, no rate rises until 2023. And in the same article at the very end, they point out 2 rate rises.
Well, I think it's sensationalism as well. I mean, part of me thinks media, I don't trust the media. I hate the media because I feel that they're going to take whatever's the most sensational article and shove that in our face until we're afraid of whatever that is. But the other side of it is, they probably don't want to precipitate some fears. And that spreading that fear that inflation is certainly rising, you could really start to put this whole thing to a grinding halt. And given the fact that we're so over leveraged, we put so much money out there, if inflation does start to rear its ugly head, those brakes get put on. I mean, it could come crashing down very quickly. A question came through here from Karen. She says, what kind of black swan event could that be? What would it look like? Usually these things are kind of one-off announcements. I think it'll come from a spike in inflation numbers that are way beyond people's expectations. If you look at CPI, you look at PPI, and the PCE price index, all of those things have been rising very steadily. Our recent numbers of CPI, especially core, showed much higher inflation than normal. And the Fed, again, conveniently dropped the word transient from their talk track, but still said, and this is the funny part, he said, we've had historically low inflation. Yes, we're targeting 2%. Right now it's above 2%, but over time it'll average out. So they've already said, it's higher than we wanted, but it's okay because we were low for the past couple of years. If that does continue to spike and we see that trend continue, they're going to have to take more aggressive actions. And I don't know if it's necessarily a black swan event, but that would certainly be a piece that gets this party to stop.
Yeah, and I agree with you. I wouldn't call it a black swan, but the minute the Fed finally throws in the towel and said, yeah, you're right, inflation is more of an issue, we're going to have to take action before 2023. Again, I'm saying they're starting to do that now.
Yes, I agree.
But when it becomes more overt and even the mainstream media can't ignore it, that's when you're going to see some major market reactions. And because the media focuses on the Fed funds rate, that'll probably be the trigger event. The minute they raise the target rate up to quarter to half, from 0 to a quarter, that's going to be them throwing in the towel.
Yeah. I think you're going to see it. I think by the end of the year, the talk track will have changed so that transient piece will certainly no longer be used. That one, I'm going to just get a shirt that just says transient on it just because I think it's such a great term. But we'll be talking, I believe, about much higher inflation numbers, and you'll see not necessarily stress on the part of the Fed, but they're going to have to do some actions. And Bill already pointed out 3 that they've done. They'll probably have to start doing a little bit more to choke that in. Black swans would come in the form of something that was just unpredictable, something that you just go, how did that happen? Maybe a fat finger event would probably be one of the things that happened to start a big spike down. COVID was obviously a black swan. Let's hope that's done and gone with because we all want to keep moving forward from that. But who knows what exactly that black swan will be.
No.
Tell me about your upcoming class. I know you're teaching a class for the Fed starting on Friday. That's awesome, but that doesn't help me because I can't go to that one. But I can go to your signature series and some other XLTs. What do you got on your plate?
Yeah, again, and my apologies to the group. For the last month, I haven't been able to do the showcases and things of that nature, but we're getting back on track. So in last week in August, I'll be doing another Bond Aid signature series. That's the 3-day ultimate fixed income 3-day signature series class. So we'll be putting that on again at the end of August, which means leading up to that, we do the showcases for that. So you'll start seeing the showcases appear on the regular schedule in July. I also am starting to do some XLTs.
Nice.
I did one this week, and I'm looking forward to, again, my schedule didn't permit one for July, but back in August 17th, I'll be doing an XLT. So August will be a busy month with OTA. I've got the XLT on the 17th, the Bond Aid class at the end of the month, and then the signature series leading up to that. So it'd be nice to be back with you guys.
Yeah, I'm looking forward to it. I'll have to be maybe a fly on the wall for that course as well. Shadow Tombini says, great series. So she might have been in that one. So
Thank you,
cool. Anything else you want to, any parting shots you got?
No, there really isn't, other than to say, watch what the Fed does, not what the press says.
Yeah.
That's really the moral of the story here. So I think we have to be careful. And anytime the Fed makes an announcement away from the regular FOMC meetings, that's usually overly significant. So, keep an eye on what the Fed is doing, not just at the FOMC meetings, but, behind the scenes.
And there's all sorts of little clues they give, I noticed that the meeting before, when Powell spoke before that Wednesday meeting, I noticed that he didn't really say the word transient much. And then all of a sudden, the other meeting, not at all. And you get these little clues about how they're positioning themselves. So, yeah, it's pretty cool.
And we do have an economic conference coming up. I forget, is it Jackson Hole or Davos? One of the big ones is coming up within the next month. So look for the Fed to maybe make some sort of start dropping things. So they like dropping hints and clues at those type of meetings. So I forget which one it is. It's the big one. Either Jackson Hole or Davos is coming up.
Yeah, I don't remember which one comes first, but I know it's coming up here soon.
Yeah. So keep an eye on that meeting too in terms of Powell's comments. That'll be important.
Yeah, I'm actually trying to pull up the date, but I picked the wrong site. It doesn't give me the date. All right. Well, no Jackson Hole Symposium dates. But I won't be going there anyway. I have been to Jackson Hole, by the way. It is beautiful. Love it, but not for the Fed. All right, Bill. Hey, man. Well, thank you so much. Sorry about Tuesday. Glad to have you back on. Hopefully, we'll get you back on more for some more Fed talk as the next meeting rolls out.
Cool. I always enjoy Merlin. Always a pleasure talking to you. I look forward to doing it again soon.
Me too. Thanks for enlightening me, buddy. Take care.
Take care, guys. Good to see you all. Bye now.
Okay. That was Bill Addiss giving us some insights into the repo market, reverse repo market, the IOER, and really evidence and proof that the Fed is tapering a little bit here. They're tightening up a little bit. Not tapering, but tightening up a little bit. To me, it's interesting to see, especially because it wasn't the forefront of conversation at the FOMC meeting last week. It was just kind of in the footnotes of it, as Bill pointed out. And that's why I start watching these guys more. I wasn't really a big fan of listening to the Fed. I think it's all blah, 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 blah. But because they've been so transparent and telegraphing things, you kind of just listen for some of the wording of things that he's saying or what he's not saying anymore, and that gave me the clue the inflation is out of control, because I believe he would have probably kept his transient conversation track, but it looks like it's going to get much worse. Anyway, Bill's awesome. If you guys would like to see Bill, he's teaching for Online Trading Academy. You can contact your local center about joining him in the XLTs, which is Extended Learning Track, or in his signature series at the end of August. You can always email me and I can forward off your information, but it's TraderMerlin@gmail.com is the easiest way to get a hold of me. But best way is just to reach out to your local center there at Online Trading Academy. All right. Let's see. I even have time to go and look at all the economic stuff for tomorrow. I am actually bullish. I think that Big Ed's probably going to ask me about my S&P. I'm still on my Amazon puts. I did close the S&P. That news from the from the Fed regarding banks just make me feel like you'll see another surge here as all of a sudden you start to get some share buybacks from the banks. If you look at XLF, here's XLE. Let's go look at XLF. You could very easily be challenging these highs in short order, given the fact that a lot of these financial firms will probably start to buy back their shares. And when they buy back their shares, that means that share price is going to increase. So not a bad one. I'll let you check maybe on buying some calls tomorrow, see what those rates are. But yeah, dump the S&P, because if you saw what happened to the SPY, we got right up there and teetering at the top. I just said, I got it. A little small, tiny little loss is enough for me, and I'm done. Let's see. Gregory, it's not a fashion show. I didn't explain my shirt. I wear flashy shirts. If you don't like it, oh well. Let's see. What else do we have? Powell needs no script. Yes, when, Gregory? I'm just so bad at reaching out to these guys, Brendan. I have so much on my plate. Reaching out and getting guests in the program has been a total chore for me. I will do my best. I keep telling you I will. All right, let's look at economic calendar for tomorrow. I didn't have a chance to print this one out for you guys, so I'll just run through some of the big stuff. Friday is rather light. You have the PCE price index, which is probably the most important piece of the day. The reason for that is the Fed has made it very clear that there's three factors they're looking at for inflationary numbers. Number one is CPI. Number two is PPI. And the most important one is the PCE price index. That comes out 1 hour before the equity markets open tomorrow. Other than that, that's pretty much it. There's really not a lot happening tomorrow. You have consumer sentiment numbers for the U.S., et cetera. But other than that, that's pretty much it. And nothing really going on the earnings front either. Okay, tomorrow, where that's a great question, Catherine. I don't know where Tilly is. Tilly used to do the market outlook on the S&P 500, but I know she was busy taking some licensing exams. I'm going to have to reach out and heckle her. Hopefully get her back to do some of those and maybe get her back on the show. So thanks for mentioning that one. I just haven't talked to her in a bit, but I'll reach out to Tilly and see if I can get Tilly back on the show. All right. I like this shirt. We all have weird taste. It's definitely one of mine. All right, guys, that's going to do it for me. I need to get off and do some stuff. I had this crazy thing happen. So I built this whole cryptocurrency program for OTA, right? It's like 250 slides of images that I'm using as the foundation. I'm going to break it all up. And for some reason, I went and edited in the classroom, came back, and all the graphics were changed. and non-recoverable. So I have to go back and fix all this stuff. It's going to be exciting. But yes, Derek Zellick. I would love to have Derek on the program as well. Let me see if I can get Derek on. Derek, I haven't spoken to Derek in quite some time. I'm writing a note right now. Derek, good guy. Cool. Well, that's going to do it for me. If you guys have questions or a topic that you want me to discuss on tomorrow's show, email is on the screen. It's TraderMerlin@gmail.com. Very easy to send me questions. And again, most of those questions I use to build shows. So if there's a specific topic, hey, let me know what it is, and hopefully I'll be able to do a show on that one. It's open door policy, and of course feedback, positive, negative, whatever you have, send it in there. If you are new, hit that subscribe button. That will do it for me. I will see you tomorrow with a nice frosty glass of whiskey on our weekend edition show. See you tomorrow, guys. Take care.